If you are over the age of 60 and you have money sitting in a bank account right now, please give this your full attention, because what we are covering today is something the vast majority of retirees in America have never been told. Not by their bank, not by their financial advisor, and not by the IRS. And that silence is costing real people real money every single year. We are talking about a federal banking rule connected to a $10,000 threshold that sounds straightforward on the surface, but has quietly disrupted the financial lives of thousands of completely honest, hardworking Americans who did absolutely nothing wrong. They simply were not informed. And after today, you will be. I'm Zane, and welcome to Senior Security Updates, the channel that exists to make sure you have the information that protects you, your family, and your retirement. Today's topic is among the most important we have ever covered. Stay with me through the entire video, because I am going to walk you through exactly how this rule works, why it catches so many innocent people off guard, and most critically, what you can do right now to make sure it never becomes a problem for you. I also want to share the story of a retired school teacher whose experience genuinely stopped me when I first heard it. We will get to that in a few minutes. But first, let me lay the foundation. Because once you understand how this rule actually operates, everything else will fall into place. The $10,000 rule. What it actually is. Under federal law, every bank in the United States is legally required to file a report whenever a cash deposit exceeds $10,000. This report goes to a federal agency called FinCEN, the Financial Crimes Enforcement Network, which operates under the U.S. Department of the Treasury. The report itself is called a Currency Transaction Report, or CTR. Here is the first thing I want you to understand clearly and completely. That report is not an accusation. It is not a red flag. It is not the beginning of a criminal investigation against you. It is simply a record, a paper trail. Banks file enormous numbers of these reports every single year, and the overwhelming majority of them result in absolutely nothing. So if you have ever made a large cash deposit and your bank filed one of these reports without informing you, please do not panic. That alone means nothing. You did not do anything wrong. That part is not what you need to worry about. What you do need to understand, the part that has caught retirees completely off guard from coast to coast, is something entirely different. The trap. What structuring actually means. At some point, awareness of the $10,000 reporting threshold began spreading through communities, through family conversations, through well-meaning advice shared at dinner tables. And the logic sounded reasonable. People started saying things like, deposit $9,800 and the bank won't have to file anything. Split it into two smaller deposits a few days apart. Have your spouse put in half at a different branch. Keep each deposit just under the limit and nobody has to deal with the paperwork. Here is the reality that most people don't discover until it is too late. That advice, that cautious, careful, trying to be smart advice, describes a federal offense. It has a name. It is called structuring. And the deeply troubling irony is this. It does not matter whether the money is completely clean. It does not matter if you earned every dollar over 4 decades of honest work. It does not matter if you paid taxes on every cent. The moment you deliberately break up a deposit specifically to avoid crossing the reporting threshold, you have committed a federal offense, regardless of where the money came from. People have had accounts frozen over this. People have lost money through asset forfeiture proceedings, and nearly all of them believed without question that they were doing nothing wrong. They thought they were being careful. They thought they were being smart. They were not aware of what the law actually says. Why the automated system doesn't care about your character. I want to pause here because I know that might sound alarming. You might be thinking that the government surely wouldn't pursue a retired person simply for splitting up a deposit. And honestly, you are right that federal prosecutors are not focused on targeting retirees who make honest mistakes. But here is what matters. The automated banking systems that monitor transaction patterns do not know you are retired. They do not know you are 72 years old and have been saving honestly your entire adult life. What they see is a sequence of deposits, each landing just under $10,000, made over a short period of time. And the system does exactly what it was designed to do. It flags the pattern. From there, the matter goes to a human reviewer. And at that point, you now have a situation on your hands. A situation that is stressful, time-consuming, potentially expensive, and entirely avoidable if you understand the rules beforehand. At Senior Security Updates, our entire purpose is to make sure you understand those rules before a situation ever arises. The 3 most common scenarios for retirees. Let me walk through the 3 situations where this issue most commonly affects retirees, because each one has a slightly different shape and each one has a straightforward solution. Scenario 1. Selling personal property for cash. Maybe you sold a vehicle that had been sitting in your garage for years. Maybe you sold personal property, furniture, tools, jewelry, a piece of land, through a private sale. The buyer hands you $11,000 in cash, you drive to the bank, and you deposit it. Your bank files a currency transaction report. Your name is now in a federal record. And I want to say this clearly one more time. That is completely fine. A report being filed does not mean anything is wrong. The mistake happens when someone who means well suggests that next time you keep it under $10,000 to avoid the hassle. And so the next time you have cash from another sale, from something else, you start splitting it. $8,000 one week, $3,000 the following week, just to keep things simple. That one well-intentioned decision is what turns a completely clean situation into something the system is specifically trained to notice. What you do instead is genuinely simple. Deposit the full amount in a single transaction. Yes, a report gets filed. That is fine. What actually protects you is the documentation. Keep the bill of sale. Keep the title transfer if one exists. Keep your deposit receipt. If anyone ever asks about that deposit, which is unlikely but possible, you have a folder with a document that tells the complete story. Conversation over. Scenario 2. Financial help from family members. This is the scenario that catches people off guard emotionally, because it involves people they love trying to help them. A son sells a business and wants to share some of the proceeds. A daughter wants to help cover medical expenses. A grandchild wants to contribute to living costs. Whatever the situation, family members trying to help will often, without realizing it, make things more complicated. Because the moment the $10,000 threshold comes up in conversation, which it almost always does, family members start offering to break it up. Send it in smaller wire transfers, they say. Have you deposit some and your spouse deposit some? Spread it over a few weeks so the bank doesn't get involved. Every one of those suggestions describes structuring. And what makes this particularly serious is that it can create legal exposure for multiple people simultaneously, not just the recipient. Both the person sending and the person receiving funds can become implicated if the transaction pattern appears deliberate. What you do instead is straightforward. Deposit the full amount in one transaction. If it arrives by wire transfer or check, a clean and transparent paper trail already exists. If it is cash, go to your bank, tell the teller it is a family gift, and deposit the entire amount. The one additional step that provides complete protection is a gift letter. And before you imagine something requiring attorneys and formal language, stop. A gift letter is simply a signed and dated statement that says, "On this date, I gave this person this amount as a personal gift with no expectation of repayment." That is all. That letter, combined with your deposit receipt, closes the story permanently. Scenario 3. Moving your own money between accounts. This is the scenario that reveals just how invisible and unfair this trap can be. And this is where the story I mentioned at the beginning of this video becomes important. She was 69 years old, a retired schoolteacher, recently widowed. Her husband had passed just a few months earlier, and she was trying to organize her financial life during one of the most difficult periods a person can experience. She and her husband had maintained accounts at 2 different banks over 30 years. She wanted to bring everything into one place, one bank, one account, one manageable picture of what she had. So she began moving the money. She did it gradually, Not because anyone told her to stay under a threshold, not because she was trying to conceal anything. She was exhausted and overwhelmed, and moving smaller amounts felt more manageable than attempting a large transaction during the worst period of her life. 6 weeks later, she received a letter asking her to explain the pattern of transactions in her account. Not a phone call, not a gentle conversation with her branch manager. A formal letter, because the bank's automated system did not know she was grieving. It did not know she had spent 34 years as a school teacher and had saved that money one paycheck at a time. It saw a series of deposits, each landing under $10,000, repeated over a short window of time. And it did exactly what it was built to do. That moment, not because what followed was catastrophic, but because she had done absolutely nothing wrong, is the reason Senior Security Updates covers topics like this one. The right approach when consolidating your own savings is this: move it in a single transaction using a wire transfer or a cashier's check. Clean, traceable, and completed in one step. If a teller asks where the funds are coming from, your answer is one sentence. These are my personal savings being transferred from my account at another bank. You do not need to elaborate. What you keep for your records: a bank statement from the originating account showing the balance before the transfer, and your wire confirmation or cashier's check receipt. If the funds came from a certificate of deposit that matured, retain that maturity notice as well. These documents take 5 minutes to gather and provide protection for the rest of your life. Your 5-layer protection strategy. Individual transactions are one thing. Your overall financial documentation posture is another. Here is a framework that provides meaningful, lasting protection. Layer 1. Source documentation. For any large cash transaction, maintain a document that explains the origin: a bill of sale, a gift letter, a transfer record, whichever applies. Without that document, you have a story. With it, you have evidence. Evidence is what protects you. Layer 2. Bank statement from the source account. The first question anyone will ever ask is not what you deposited. They can already see that. The first question is where it came from before it reached you. A document answering that question typically ends the conversation immediately. Layer 3. Transfer confirmation. Your wire receipt, your cashier's check stub, whatever physical record reflects the transaction. Retain it for at least 3 years. Filing it away takes seconds and could save you significant stress later. Layer 4. Consistency between your bank records and your tax return. This one is critically important and rarely discussed. If you sold property or personal items for cash and deposited the proceeds, that transaction may need to be reflected on your tax return depending on the amount and any gain involved. When your bank records and your tax return tell a consistent, aligned story, there is nothing to investigate. The paper trail is complete. Layer 5. Responding, once, clearly, with documentation. If anyone ever follows up, your bank, a government agency, anyone with questions about a transaction, answer once, clearly, with your documents in front of you. Do not over-explain. Do not volunteer information that was not requested. Do not follow up the next day with additional details because you were nervous. One clear documented answer is your protection. If it ever feels like something more serious than a routine question, stop speaking immediately and consult a CPA or tax attorney before saying anything further to anyone. 3 beliefs that create false security. Let me address 3 assumptions I hear repeatedly that are genuinely dangerous. If I just keep it under $10,000, I'm safe. You are not, and you are actually more exposed. A deposit of $9,900 is among the most consistently flagged amounts in the banking system, not because of a single rule, but because pattern recognition software is specifically trained to identify people who appear aware of the threshold and are attempting to stay below it. Repeated deposits landing just under $10,000 are not invisible. They are a signal. If your amount is $11,000, the correct action is to deposit $11,000 all at once. This only happens to people who did something wrong. It does not. The system is automated. It has no knowledge of your character, your history, your age, or your intentions. It identifies patterns and generates reports. Entirely innocent retirees receive letters and face account reviews every year, not because they are suspected of wrongdoing, but because a transaction pattern matched what the software was trained to flag. Your integrity does not protect you. Your documentation does. I'm retired and on a fixed income, so I'm not on anyone's radar. There is no age exemption in federal banking law. There is no retirement exemption. A 74-year-old making a cash deposit is subject to the exact same reporting requirements as a 35-year-old business owner. Your age is not a shield. What you keep on file is. Closing thoughts from Zane at Senior Security Updates. Here is what I want to leave you with. This rule exists for a legitimate purpose. It was designed to help identify serious financial crimes, money laundering, large-scale fraud, tax evasion at a significant level. It was never intended to create problems for retired people who sold a vehicle, received a gift from a family member, or moved their own savings after losing a spouse. But the system catches people regardless of their intentions, because it cannot see your intentions. It can only see your transactions. You are no longer in that vulnerable group. You now understand what the rule actually is. You understand that making a large deposit does not create a problem. Deliberately splitting a deposit to stay below the threshold does. You understand what documentation protects you and why it matters. And you understand that the most damaging thing you can do is follow advice that sounds careful but is actually illegal. Here at Senior Security Updates, we cover the topics that matter most to your financial security and peace of mind. The ones that most channels never address because they assume you already know. If this video gave you clarity today, please take a moment to engage with it. It costs you nothing, and it helps this information reach other retirees who need it just as much as you did before you watched this. Leave a comment below and tell the Seniors Security Updates team which of the 3 scenarios we covered is most relevant to your situation: property sales, family gifts, or moving your own savings. Your questions and comments directly shape the content Zane and the team produce next. And if you have not yet subscribed to Senior Security Updates, now is the time, because our next video covers another area of retirement finance that almost no one explains clearly, and it directly affects how much of your money you actually keep in 2026 and beyond. This video is intended for general informational and educational purposes only. It does not constitute financial, legal, or tax advice. Please consult a qualified CPA or licensed attorney for guidance specific to your personal situation. Thanks for watching. Stay informed, stay protected, and we will see you in the next one, right here on Senior Security Updates.